Dawn, did you ever imagine that we'd be here 6 weeks into the Trump 2.0 era and the Dow is flirting with negative, the S&P 500 is down 2.5%, the NASDAQ is down 6+? Did you?
I would have thought that the markets would have held up better, but I would also not have thought that we would have had the level of frenetic activity out of Washington. And when we look at the headlines over the past 24 hours, they've been kind of breathtaking in speed and scale.
I'd like to point out, because some of you here may not know, or perhaps you've forgotten, that the Treasury Secretary, Scott Bessent, once had Dawn's job as Chief Investment Officer. He worked at Soros in the 1990s under George, of course, and also under Stan Druckenmiller, and he returned as the CIO in 2011. You arrived in 2017, a couple of years after he left, right?
I arrived about a year after he left.
I bring this up not just to establish a distinguished lineage, but because it serves as a useful reminder that Scott Bessent has to be, right, the most market literate and market savvy Treasury Secretary since at least Bob Rubin and perhaps in American history. Now we have a president whom we know thinks of the stock market as a daily report card and a Treasury Secretary who's laser focused on macro indicators. Why is that important?
So a couple things. Scott is incredibly smart. He's capable, and I think he is the most market-savvy Treasury Secretary we've ever had. I think it matters because when he says something, you should take him literally. So he has said he and Trump care about the level of 10-year treasuries, and I think he will pay very close attention. In a kind of perverse way, right after the election, we had the Trump bump, and as Erik pointed out, we've had something different in the past week or so, and you've seen that 10-year Treasury go from 480 in the middle of January, where they were getting nervous, and if you remember, they kind of backed off some of the tariff timing at that moment in time. Now you have a 10-year Treasury that's down at the 412 level. And I think they should be getting a little nervous. I think the one thing that market participants maybe have underestimated, in the first term, we all said Trump is very SPX sensitive. And that was invariably the truth. I think with Scott, I think their pain tolerance is different. And I think they're more sensitive to a broader set of asset classes. And I think they might believe that ultimately they have more levers to pull when and where they need it. That said, when you think about tariffs, we can all look at a textbook and we can say, and I think the Treasury Secretary said it today, manufacturers will absorb the price pressure. And then you can also argue that it's a one-time price shift. But I think what you can't control is consumer confidence and corporate confidence. And I think that is what is falling off a cliff right now.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
So I would take the other side of that bet because, again, I think ultimately they will bear more pain than I think market participants originally thought, but there will be a limit. And I think they will make deals.
There's a view in the market that Scott's preoccupation with keeping the 10-year yield low foreshadows a coming change in bank regulation. You know, if the administration wants to juice demand for treasuries, it could exempt treasuries from the supplementary leverage ratio, one of the capital penalties that the big U.S. banks have to pay. Do you think they'll go there?
So I definitively think that is going to happen. So when you look at kind of the net issuance of treasuries post-COVID, it's almost all been bought by the levered hedge fund community. And I don't think, first of all, that's not a sustainable kind of marginal buyer. and it also probably isn't good for market structure and market stability. And when you look at what came out of Congress last week, the deficit is not going lower in any material way. So what I think they're going to do is they will change bank regulation and the supplemental leverage ratio, allowing banks to buy treasuries in ways that won't be regulatorily punitive. And the next step is they will try to take some leverage out of kind of that basis trade and the levered market. And again, I think this is where Scott understands the moving parts in ways that I think will ultimately be really helpful.
You've given us a couple of clues about how you might be trading the bond market. You take the other side of 3 rate cuts this year, but at the same time, you think that the administration will be inclined to help lift demand for treasuries. How are you trading treasuries? Like, what would you buy and where? And are you a holder or are you a seller at any point?
So we are a reasonably large holder of U.S. government bonds, but we're below our benchmark weight by a little bit. And what we've been doing is we've been using volatility as our friend. So in January, when the 10-year rate spiked, we were buyers of bonds at that time. And then now, as you've seen kind of rates go lower, bonds rally a lot, we're not taking profits. And you'll see us continue to build a position into that volatility. And I think you're going to see continued volatility. Again, this moment in time, rates are going lower, but I don't think that's going to be true for the next 4 years.
Volatility can be your friend. Is that? I guess I better put it this way. What's the best thing and what's the worst thing about trying to put money to work in this market?
Yeah, so we're technically an endowment, but we use the best of the endowment model and the hedge fund model, so we can react very quickly. And I think we're very good. I would argue probably one of the best in the world at connecting the dots across asset classes. And from our perspective right now, the volatility is great. I think market structure is still challenged in that liquidity at moments in time when there's a lot of volatility is challenging. So you can see a great trade, but sometimes buying as much of it as you want is easier said than done.
Do you have a favorite trade right now?
Yeah, that's a good question. So we are tactically, at the end of last year, we bought call spreads on Hong Kong equity indexes. And I continue to like that trade, so we're holding that position. And again, when you see kind of the micro and macroeconomic data coming out of the U.S. and you see the data in China, I think you will see a tactical deal out of economic necessity between China and the U.S. And I think when you look at investors generally, they've left China for dead. So I think there's going to be money forced into that market. Again, for us, that's more of a short-term tactical trade than a longer-term position.
I feel like I have to ask you the requisite Mag 7 question. Those stocks are down about 13% or so from the peak in December. That was, as of yesterday, I didn't check this morning, probably down by more. Tesla's off, 40? NVIDIA's lost 24%. Are those buying opportunities?
Yeah, so I think the Mag 7 those are extraordinary companies with real earnings power, and the unwind here has been pretty violent. So I would take the other side of that trade.
And of course, we are witnessing some historic shifts in U.S. foreign policy. It would appear that the United States is to a degree abandoning Europe, perhaps embracing Russia and Vladimir Putin. Has that translated? Will it translate into great macro trades?
Yeah, so, Russia's not that relevant from a trading perspective. When they invaded Ukraine, it didn't really reverberate through markets. And I think in the context of what's going on now, The only thing that's worth watching, in my opinion, in the context of trading markets is oil. And whether ultimately, and this is a big if Trump can negotiate a peace between Russia and Ukraine, whether part of that deal is Trump needs more oil, right? Part of what he's been promising the U.S. consumer is lower prices, and particularly lower prices when it comes to the gas pump. The U.S. really can't drill more. It's not in Saudi Arabia's best interest to produce a lot more. They need about $90 a barrel to balance their budget. So the lever he can really pull there is Russia. And one kind of wild card would be Russia dropping out of OPEC. And that would have a real impact on oil price in the context of moving it lower.
What about America ripping the security blanket away from Europe? You know, I could imagine that we've already seen, right, the Germans move toward spending. In fact, I think they found some flexibility this morning, right? 200 billion euros on additional 200 billion on defense. And we hear the same noises out of France. Surely that has to, result in at least some bond issuance.
Yeah. So if you look at Europe, and if they end up spending the 2.5%, to 3% of GDP on defense, that's $175 billion a year. And when you think about the fiscal space they need just generally, the amount of bond issuance out of the EU and European sovereigns is going very materially higher at the same time when U.S. net issuance is also going higher. So I think one of the things that we might see, and this isn't going to happen tomorrow, but I think it could happen in the next 12 to 24 months, is a failed auction out of Europe. I just think at some point, sourcing that marginal buyer is going to become extremely difficult.
Do you feel confident enough to predict which country will fail to sell enough bonds?
The two most vulnerable countries are the UK and France, in my opinion.
Don, there's a lot of Western money, including some of yours, trapped in bets on Chinese private companies. ByteDance, of course, tops the list, but there are lots of others. Could that logjam maybe start to break if Presidents Trump and Xi negotiate some kind of a deal, whether it concerns trade or whether it goes even beyond trade?
So I think there's a lot of people hoping for that, and as Erik said, us included, where we have private capital in China, and we've been, everyone thought these companies would come public years ago, and the markets just didn't allow for that. And if you remember, the Chinese government kind of closed that door at the 18th hour. So if there is a tactical deal between the U.S. and China, I think there's a lot of market participants, us included, that will hope that the private to public markets unfreeze and we can get some money out. I think if you get money out of privates, it's only going to be in that very, very tight top tier, like a ByteDance. And to be clear, ByteDance is probably the most largely held private company by real asset investors in the world. So there's a lot of people with that hope trade on.
This feels like a good time for us to wade into the public-private debate for a moment. Because for years, right, foundations like yours and endowments and pension funds and sovereigns have been plowing money into private equity. Of course, they've had some trouble getting that money out of private equity over the past couple of years. And now private credit is the rage. And more capital, as a result, is flowing into illiquid vehicles. Why do you believe in liquidity when everyone else, right, from Apollo to BlackRock, is extolling the virtues and the benefits of private markets?
Yeah, so over the last, again, we typically are benchmarked against the typical largest U.S. endowments, but over the last 6 years, we actually let our private equity positions roll off. We still allocated to the best managers, but with a really high bar. So we lost about 1,000 basis points of exposure there, which, to be clear, has served us really well. And at the same time, we pivoted to public markets. And it's interesting. I think a lot of both high net worth and institutional investors pivoted to private markets in part because you didn't get a scorecard every day, and your Sharpe ratio and the returns looked artificially good. And by doing that, first of all, I think those investors are in a world of hurt right now, both in context of liquidity and in the context of they've massively lagged a equity market that has until the last couple of weeks been on fire. But the other thing is, if you're Soros Fund Management and you have a long-term perspective in public markets, you have a lot less competition because it's most of the active money is large multi-strat investors. So for us, the capital allocated to public markets above our benchmark, we've annualized 650 basis points of excess return over the last 5 years. And I think it's because we play our own game.
What does that mean in actual numbers? 650 over what last year? 650 over what in 2023?
So it's always our beta benchmark is MSCI ACWI, and then we have the risk-free rate. So we don't give ourselves any credit for what you can get, by in money markets or what you can get by buying beta, and we assume we're at our benchmark weight in those. So add those together and then add 650 basis points. By the way, the thing that's pretty interesting is when you look at the last 2 years, your private equity has lagged by more than that. So you needed that active return in public markets to make up for the sins in private equity. But we think our peer endowments and foundations haven't had that offset.
So you're thinking more along the lines of a hedge fund. Tell us what you returned in 24, what are you year to date, and when you look at those numbers, do you think of your competition as Citadel, or do you think of your competition as the Ford Foundation?
So we think of both. Like, we want to be clear, we want to take the best from both of those operators, but we don't play Citadel's game. There is no one. Citadel plays the multi-strat game, and nobody plays it better than them. And I think the distance between Citadel and their competition has only grown. And again, relative to other foundations and endowments, there are some things they do really well, and we like to take those pieces. But again, play our own game and play a game that we think no one else in the world can do quite the way we do it.